In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back, Market Rebels. It's that time again, Thursday, 4 p.m. Eastern. It's time for Coach's Corner, and we bring this to you every week to help you make better decisions as traders. And we try to revolve some of our world-class coaches in here. Stu is a permanent guest on here, but it's really to help people make better trading decisions. And Stu, kind of a weird day today, wasn't it? I think we were up like 400 points in the Dow.
Almost, we have real strong opening, little tiny bit of follow through in the opening, and then pretty much for the rest of the day, most of the day, really just down, kind of down. Lower
red
lows,
candles,
highs, fair amount of bearish sentiment in the price action today.
Yeah. So where did we close? Kind of flat, slightly down.
Yeah, real flat, within a quarter of 1%.
Yeah, that's what I thought. Yeah, I didn't see the actual close, but interesting.
Yeah.
But anyway, what we wanted to do for everybody today is a little bit of a follow-up from last week where we talked about what's called a three-strike pricing relationship. There's a lot of different what are called pricing rules or pricing relationships in the options market, really in finance. And they're super important to understand because that's really what drives a strategy. Everybody thinks, the reason you do a butterfly is because you think the stock is sitting still. Not true. That's going to get you hurt. The reason for doing it is you're looking for an edge and that there's some kind of an imbalance with these three strikes. So that's what we looked at this week. And we thought, you know what? Let's do another one that's similar. Right, Stu? So let's take a look at our Chalk Talk question of the day. Now, for anybody who's new, this is something we throw out at the beginning of the presentation here, little thought question, and then we'll come back at the end and answer it. So here we go. We've got three strikes. We've got a 95, 100, and 120. These are the corresponding prices from a pricing model. All right, so that's going to be important because in order for these relationships to work, they have to hold according to the pricing models, which is if they don't in the real world, that's what sets up the potential trade. So we got the 95 call at 911. 100 call at 760, the 120 call at $1.16. Now, it turns out it doesn't matter where the stock is. I happen to do it with the stock at 100. But again, as long as they're generated from a pricing model, this pricing relationship will always hold. So the question again for the group, do you see anything wrong with those three prices? What would you do for the trade here, if anything? All right, so that's our question. Stu will come back and answer it. But to do that, we need a three-strike pricing relationship with unequal spacing. Now, again, last week what we looked at was equal spacing, and we're now going to give it a slight tweak and look at unequal spacing. So what does it mean to have equal spacing? Well, this is what we looked at last week. Let's say, I think we used the 95, 100, and 105 strikes.
We did, yeah.
Okay, so those were equally spaced. And all we're talking about is that the distance between 95 and 100 is the same as 100 to 105. They don't have to be 5 points apart. We could make them 10, 20 points. But as long as they're equally spaced, that conforms to one pricing relationship. When they're not equally spaced, it's going to change. So let's
Bill, should we just take a minute and just not even a minute, maybe 15 seconds, and just maybe outline, the butterfly, what the butterfly is, 1, 2, 1, just make sure that people know that.
Yeah, we can do that. And then we're going to look at a reason why. So the butterfly strategy involves 3 consecutive strikes. And again, they don't have to be equal, but most of the time, the textbook basic butterfly is that they're all equal. You're going to buy the first strike, sell 2 of the middle strike, and then buy 1 of the higher strike. It's a 1 to 2 to 1 ratio. So that would be 1 butterfly. If you did 2, 4, 2, it would be 2 butterflies. Now, in the trading world, we call these outside ones the wings and the center one the body. So it's going to look, I'm using different strikes for this picture, but it's going to look something like this. Sometimes call it our witch's hat is what it looks like.
And when you're trying to talk to somebody about what it is that you're doing, and when you're trying to refer to a fly, you generally you're going to refer to the fly as the middle strike. So if you're doing the 100, 110, 120, you're going to say, yeah, I did the 110 fly, and you might say I did the 110 fly with a 10-point wing, and then everybody knows what everybody else is talking about. Everything is described. Right. All you really got to say is did I buy it? Did I sell it? Or what you're doing.
Exactly.
That's
now
right.
Here's where the reason for understanding this new relationship that we want to show you with unequal spacing, because when you get to better levels of trading, higher levels of trading, which is what we like to teach here, you're going to find that, let's say this is a 100, 110, 120 butterfly, or as Stu said, a 110 fly with 10-point wings. That just means we're putting 10 points on either side of the center. But what most traders do is they look at this as one butterfly. And that's okay. You could certainly look at it that way. But now you either have it all work or it all doesn't. Or they say, it's not working, let me shut it down. And they don't realize there's other trades in here to do. So one of the things is to realize that all butterflies have what are called embedded butterflies. So in this case, we would have the 100, 105, 110 is another kind of a mini butterfly inside of that.
Yeah.
We have two.
We talk about this a lot, Bill.
Yeah.
A lot of things that you got to do, not only here, but really in life, is you have to think about the things that you can't see.
Oh, right? Yeah.
If you have the 10 fly on 100, 110, 120, and you have, which you most likely would, have strikes in between, they're there. That's but right. You're not really paying attention to them because you don't have a position in them. So why would you even think about them?
That's right.
Well, you have to think about them because they are there, and they might provide some relief for you. They might provide a decrease in risk. They could do things for you that if you don't see them and you don't engage them, then they're just not helping you.
That's the whole, exactly right. That's the whole point. Now, I'm assuming that we've got these in 5-point increments, that we have a 100 strike, a 105, a 110, and so on. They might be in 2.5 points, and that's going to double up. So now we actually have 2 in the center. I've got 1 out here in the wing. And look at that. We actually have 1, 2, 1. There's actually 4 butterflies inside of that one. Now, to show this, sometimes people think that's just some kind of sleight of hand geometry here, something that's not true. So take a look. If we put this into a pricing model, and I would encourage everyone to do this, the 100, 110, 1 butterfly, pick your expirations, pick your volatility, but make them consistent. This butterfly costs $386. Now, if you go and you look at the 100, 105, 110, it's going to cost 94 cents. The 105, 110, 115 in red, we were doing it twice. Remember, there's 2 of them, is $1.03 each. So 206 total. And this guy out here in the wing, the 110, 115, 120, would be priced at 86 cents. And if you add these up, right, if you bought all 4 of these, look at that, comes up to exactly, to the penny, the same thing.
Yeah, you're just breaking down the engine into its component parts here.
That's exactly right. Yep, you're just breaking it down.
Out some of these parts to kind of make things, run a little more efficiently.
Yeah, you might find that, okay, the overall butterfly in black isn't doing so well because the stock has moved down here to 105. Well, maybe the blue butterfly is doing great, or at least doing something. And maybe you could close this butterfly. Yeah. But here's the catch. When you're doing this and breaking these apart, because remember, butterflies can be viewed as 2 vertical spreads. We can see them as strangles. We can also see them as broken wing butterflies. And this is where the unequal spacing comes in. So as you're in here navigating around and trading these, you might end up with a broken wing butterfly or one with unequal spacing.
Which is fine.
Which is absolutely fine. But too many people just, they back away from it. So that's what we're here to figure out, this 3-strike pricing relationship. So this is a little bit of a background for the motivation why we want to do it. So before we show you some more, as always, please visit us at marketrebellion.com/get started, especially for anybody who's new. We've got a lot of great free materials on there. I think there's some Word docs, maybe some PDFs or some videos, all free, but will certainly help you to get started. And it's super important.
I'm sorry, go ahead.
It's super important that you get good information, because there's a lot of bad stuff out there on the web.
A lot of bad stuff. When you're thinking about these butterflies, or when you're thinking about the strategy, and the questions I always get is like, when would I use it? Why would I use it? What do I do with it? It really helps just look at what it is. And Bill kind of gave it away a little bit before when he said, you can look at it as two verticals or strangles, and
strangle straddle. Yep.
I find this is just me, I'm just me. So I find the easiest way to think about what this is and how it works, at least in the beginning, is to just look at it as two separate verticals. There's a vertical on one side, there's a vertical on the other. One you're long, one you're short. It's 1 by 2 by 1. You're long one, you're short one. Bang, that's your vertical spread. Then on the other side, you're short one and you're long one. That's your vertical spread.
Yep.
And they're just married at the hip. That's all. It's just, putting 2 of these vertical spreads together. And, and then from that, you could divert off into a condor, and you could just, you kind of spread the range out a little bit, but it's the same idea. It's just 2 vertical spreads. One does one thing, one does another. And inside of that statement is every option is going to do what every option does. It doesn't really matter. It just, they're going to do what they're going to do. So now what we're doing here is we're just going to try to tell you, as always, that there's always a relationship between one and the other one, whatever the other one is, whether it's one vertical spread versus the other vertical spread, or one option versus the next option versus the next option. And when you break it apart into its component parts, which I always kind of tell people to do, just think about it the easy way. Don't get lost in the mush. Just think about what it is. And what it is just a vertical spread. So
2 vertical spreads. Yep. You got a debit spread and a credit spread. If you're talking about a standard butterfly, there are other versions. We can get into the credit versions, the gut irons, the all kinds of different ones. But we're just, at least for right now, talking about a standard butterfly. So let's now look at 3 consecutive strikes. Let's look at the 95 for 911, the 100 call for 646, and the 120 call for $1.16. Again, these are generated from a pricing model. So I shouldn't really have said consecutive strikes, but they're on the same. They're all on the same board, but these are with unequal spacing. This is what we're talking about. We went from 95 to 100, which is a 5-point gap, and from 100 to 120. Well, now the question we want to answer this week, what's the relationship of the center strike, the 100, in relation to the wings? What can we say about them? Now, last week we said that the average of the wings has to be greater than the price of the center. It's a similar thing.
Otherwise, it's an ARB.
Or otherwise, it's an ARB. Right. And that's, and if it even starts pushing those boundaries, that's what sets up the butterfly, not the fact that you think the stock is sitting still.
Yeah, and an ARB means it's just, it's free. It's free
money,
or it's credit. It's less than free. Like who would, if somebody said to you, look, here's an opportunity to make $5 on this spread, and you said, how much is it going to cost? And they said nothing.
Or said, I'll pay you $5 for it.
Yeah. Would you say, nah, I'm not interested?
Right, of course not.
Somebody's going to hand you an opportunity that could be worth something at some point for nothing. You have
no reason to turn it down.
You're not going to turn it down. It's everything to gain and nothing to lose. So of course you're going to do it. But then what the market does, the markets, of course, will step in and fix that pricing, whereas now it won't be without risk.
And there's your trading opportunity.
Yeah.
Right. This is what you can participate in. So if we were to look at this as a standard, at least in the standard ratios, buy one, sell two, buy one, notice because we've got this extra distance out here, there's more room to fall going from 100 to 120 than there is to rise from 95 to 100. And this is the resulting risk graph. And now you see why it's called a broken wing butterfly.
Yeah. So think about what's going on in the middle there at that. Which one was it? I forget. The 100?
95, 100, 120.
Right. So that means if you're long one and short two, that means what is the short, right? Short, let's go back to basics. The short is an obligation. When you sell something, when you own it, you have a right. When you sell it, you have an obligation. You give somebody else the right. That makes you an obligor, right? You have an obligation. If you have an obligation of 105, well, that means that you have only one right to two obligations. Well, where do you cover? Where can you cover the other obligation on the way up if it's going against you? And that's what this is, right? This is presenting this like additional risk, because you say to yourself, and I kind of remember in one of my morning meeting sessions, like, Stu, where's your protection? And I said, it's like up here. And the guy looked at me like I was out of my mind. He told me to fix it. So the protection is all the way up at 120. So that means from 105 to 120, you're completely exposed on the battlefield. Where's your protector? Where's your armor? Where's your overhead people that are looking after you? They're not there. They're on the other side of the hill. So this is the approach that you got to kind of look at. Like, how can I fix this?
Yep. And that's a good point, because a lot of times what we do in trading is rebalance. This actually has a bearish bias, because if we look at the overall, it's kind of favoring the downside. If you had to pick a direction, we'd rather see the stock fall. So there's an overall bearish bias, but we might want to rebalance this and bring these wings more in line. And this is, again, where you have to understand this. So this is what we're going to take a look at. How could we figure out this relationship? What can we say about the center strike in relation to the wings? All right. So as always, please visit us, marketrebellion.com/get started. Okay. So here's what we're going to do. There's a little trick. I'm going to show you a kind of a mathematical way, and then we're going to show you a real easy visual way that will help you to understand it. So here are the three strikes. You're going to look at the difference of these, the middle to the outer wing. There's a 20-point difference. And then we're going to compare that to the difference of the wings. There's a 25-point difference. And we're just going to divide those out. So 20 divided by 25 is 0.8. There's the magic. What it means is we need 80% of the weight in this first strike, and the balance, or 20%, in this strike. And if we do that, then we're going to find out that these 80% of this plus 20% of this must be greater than the price of the one in the center. Now, again, last week, it's really the same pricing principle, but these weights would just be 50-50. So last week was really a special case of this. If you understand this one, you understand them all. This will work for the equally spaced, you'll just find out that the weights are 50-50. So let's go find out, Stu, and see if this really works. And to do that, we're going to bring up an Excel spreadsheet that I have created here for the group. Okay, so let's step in and kind of explain this first. Over here, we have a list of stock prices, right, ranging from 60 up to 145. Here's the 95 call, priced at 911 and change. Here's the 100 strike at 646 and the 120 at $1.15. These are the prices that we saw. Now, what we're looking at in these columns is what would this call be worth at expiration given these prices? All right, so you can see that for the 95 strike, if the stock is 95 or below, the call expires worthless and you would lose 911. That's why the minus 911 is there. If it goes to 100, you pick up 5 points. So you'll kind of not reduce that by 5 points. So that would be 411 and so on up the line. Well, that's all we're doing for each column.
Yeah, these columns to the right of the stock price are just your P&L columns.
They're just P&L. Now, what I've done here is we're looking at the long 95, 120. These are the two that we're buying, right? That was part of the butterfly. You're buying the wings, selling two of the center. So these are
911 and 116. Follow the money. 9 and 11 and 116. Add them together, 1027. If they both go out worthless, bang, you're out 1027.
Out 1027. Now, the short two is going to be assuming that we're shorting this. Now, this column, I have to say I made long. I usually make all the spreadsheets long, and then I fix it in the math over here, doing plus this one, minus this one. So these are actually assuming that they're too long. But we're looking at these as if we bought these two. All right, so 646 twice is 1293 and so on down the line. Now what we're going to do is say, let's take this P&L minus this one, and that gives us positive 265.
There you go, right?
So it's always this one minus this one.
Yep.
And if we do this all the way down, we get this graph in blue. So you can see right there, those are where those numbers are coming from. This over here is just the horizontal axis. All right, so there's the butterfly, the broken wing. Now, notice we have it in a long one on these wings and short two. Now, what was our ratio here, Stu? I've recalculated it over here again, but it's just 20 divided by 25 or 0.8. Right? That's not always going to be true. We have to figure out that ratio each time. So what this means is that if I'm going to be short two in the center, I need to have 80% of this on the left wing and 20% on the right. So what's 80% of two? Is 1.6. Now, we can't buy 1.6 contracts in the market, but mathematically, there's nothing wrong with it. So let's do 1.6 and 0.4, and look at that. We have balanced these guys out. Now, even more interesting, you can see that the maximum loss, if you were to buy this, is 212. But take a look up here. Here's 80% of this strike is 729. Here's 20% of this strike is 23 cents. We add them up, that's 752. The rule says this price has to be greater than this one. Is 752 greater than 646? Yes, it is. Now, even more interesting, how much greater? $1.06. So notice if we did that twice, that would be 212, and that's exactly the amount of the max loss, and that means our entire risk curve would be sitting on zero, and we couldn't lose.
Which is a good thing, by the way, everyone.
That would be a nice thing. But that's why we know that this relationship has to work. So once you uncover this, when you're taking a regular butterfly and peeling them apart, let's say that we had 10 short here in the center. All right, what would we have to do to balance? We know we need 80% of that, which is what? 80% of 10 is 8, I think. There we go. What's 20% of that? I believe that would be 2. And we should, if we get everything right, get right back to the same picture. Now, of course, we'll have different prices, and we can tell that that would be $5.30 because twice that would be $10.60. And that would, again, balance this out. So no matter what numbers you put in here, let's try it with 20, Stu, and see if it works. Okay. 80% of that would be 16, and the balance would be 4. And if we do this right, we should get, drum roll please, a balanced butterfly.
Right. So I said to Bill, I said, well, listen, we're going to kind of do this one time, you can't really do 1.6. And of course, Bill, being the smartest guy on the planet, says, well, just up the middle ones to kind of find the common denominator and then balance it out like you're seeing here.
Right. So anyway, this is the thing that we want you to take from this presentation is that when you have 3 strikes like this, even if you're not using it for a butterfly, maybe you're looking for a vertical spread, where might be one that is relatively high priced and relatively low priced. This would be another method you could use. But the relationship says, let's go back to 1, 1, and 2. The relationship says that 80%, now again, it's not always going to be 80, whatever the ratio is that we calculate, but 80% of this number, the left wing, 729, plus 20% of this price, 23 cents, we add them together, it's going to cost you $7.52 for the wings. And if you sold the center once, would be $6.46. So what the rule is saying is that the weighted average here, $7.52, absolutely must be greater than this price right here. Because if it's not, if we sell this one twice, we could get $2.12, and we'd find out that's exactly was the amount that we would end up with a free trade. So that's really the basics of it. So we'd have to go back to a
and here's the big picture.
Let's do 1 point.
Bill is such a genius, and you delve into this, and when you understand all the math and all that, it just absolutely makes perfect sense. Here's the big giant picture looking down from 30,000 feet. You are short an extra 100 deltas at expiration, right? At the 100 line, right? That's it. You're short an extra 100 deltas at the other line. Okay. Right. Step 2. How do you fix it? Step 3. I need more firepower up front on the 95 line.
Yep. So let's do that, Stu. Let's do that before we. Here's what Stu is talking about. I said earlier we could show you a good visual way. We showed you the kind of the hardcore mathematic way. But take a look at this. In fact, you know what? To even see this easier, let's do a payoff diagram where they're all at 0. Now we don't have to worry about prices. So we start at 0. Notice from 95 to 100, what is that? That's 5 points you could gain because you're long the 95 and short. Actually, you're short 200. But for right now, just think that you're short 1. Right. There's your 5-point spread.
Right. This is just what's it going to be worth? What are these options going to be worth? The stock's at 100 and you have a 95 call. So this goes back to the basics. I was just doing this with somebody this morning. Intrinsic and extrinsic value. Intrinsic and extrinsic value. Always go back to that. Think about that. The extrinsic goes away 100% of the time. That's your time value. It goes away by distance. It goes away by time and or both. And the 95 is going to be a cash value. It's called moneyness, cash value in the money. It's $5. It's the right to pay 95 for an asset that's trading at 100. It's got to be $5.
$5.
That's where you get that peak.
That's where that 5 is coming from. And that's easy to see if we price these at 0. So now think about what's happening. You just put $5 in your pocket, but look to this side. You're going from 100 to 120, which is what?
20.
A 20-point loss.
Yeah.
But now if we couple this with the 5-point gain, it's really a what? I'm sorry, with the 5-point gain here to the 20-point loss is a 4-to-1 ratio.
Right.
And look what our ratio is here. 80-20.
And and in dollars,
there's your 4-to-1.
Right. And in dollars, it would mean a $15 loss. Make 20, lose 5. How do you fix it? See, that's the gist of what you, as a risk manager, you want to look for the holes. How do I lose? This looks cool. Maybe, I think the stock is going here. Okay. How am I going to lose? How am I going to lose? Look for the holes, look for the missing link and try and figure out how to fix the holes, patch the holes, do the best that you can to not get hit with something that, you didn't think of when you're trying to figure out the risk reward policy here. It's not about what you're going to make. We know what we can make. We know that the peak is going to be at 100, right? That's a given. What are you going to lose if the whole thing goes bust? And how do I fix it? Right? You can get buried. You can get buried on the way up. while the extra 105 call that you're short is waiting for somebody to come save him, he's going to be a long time, man. He's like 4 miles out in the ocean.
Yep. Yep.
Right.
Exactly.
That boat's
So
way into the sunset.
so again, the simple thing to look at, the visual, without going through these calculations, is to look that there's 5 points to be made here and 20 points to be lost here. And so what that tells you is that it's a 4-to-1 ratio. And so we now know that if I need to balance this out, I need 4 times the firepower on this left wing. So that's where we came up with 0.8 and 0.2. Isn't that 4 times as much? See, that it all starts to make sense. In fact, we could have given this formula instead of saying the difference in these divided by the difference in these. I could have done these, and we would have had 5 out of 20, which would have been, 5 out of the 20, which would be, what we're looking at. Yeah, 5 and 20, which would be 4, which would be your 4-to-1 ratio. All right, so you have to say they're just different ways of coming up to the same conclusion.
Yeah, and it's all the same conclusion, right? The numbers don't change and the numbers don't really lie, at least in this situation, right? The numbers are what the numbers are because the extrinsic goes away and what you're left is with the cash value. And as you're riding 100 shares or 100 deltas up from 105 to 120, you're out $15.
Yep.
Right. And from 95 to 120, it's $25. So when you put them all together, no matter how you cut it, you got to cover the deltas up front. You cover it with extra contracts or extra, and that would be extra deltas.
More deltas. Yep. Yeah. So let's do one last one and we'll sign off here for our crowd. So here's one for you to try. You're 10 short. By looking at that butterfly, we know it was 5 and 20 or 4-to-1. So we know that we need 4 times as many here. But how do we do that? We have to have a total of 10 because we want to be net contract of 0, right? That's why we had
very important
over
very
here
important.
At the far right, right? This is why we're long 2 in green, and we're short 2. That's a net contract of 0.
Let's spend just a second talking about that. This is about being net contract 0. This isn't about hey, I'm going to sell 20 calls and hope they kind of go out worthless. It's not about that at all. This is net contract 0. This means that if the stock, no matter what the stock does, if the stock goes from 100 to 200, at least you're covered. You don't have any open net contracts. Net means net. Doesn't mean gross. It means net. So 1, 2, 1. 1 and 1 is 2, and that's 2 long and 2 short. Whatever it is, it's going to be net contract flat. Okay.
Right. So let's do 10. We know we have to be long 10 to be net contract 0, but they have to be in a 4-to-1 ratio. So again, this is where you could kind of hunt and peck and try to figure out. But the easy way is to say I need 80% of this number, which would be 8. And therefore I need 20% of this number, which would be 2. And isn't that in a 4-to-1 ratio? See, that's where that's coming from when we saw this picture right there. Okay, 5 on this side, 20 on this side. It's a 4-to-1 ratio. So anyway, listen, I know it can get confusing, but we really have a very powerful message to make here at Market Rebellion for all of the people who want to get better. As Stu said, there's usually a lot more that you're not seeing behind a strategy, potential trading opportunities that everybody misses because they listen to some guy on a blog somewhere on YouTube saying, "Oh, I think the stock is going here. Let me show you how to buy this call." That's going to get you hurt. You have to know how to make decisions as things change. And one of the best ways is to understand your pricing relationships. So we hope that gives you a little something to work with. And if not, please join us again at marketrebellion.com/get started for more information. Stu, any final closing comments?
Yeah. Practice this.
Definitely.
Practice it. Go into your analyze tab. Practice it on, practice it on your analyze tab. Look at the risk graphs. Look at your up and down. I think on TOS they call it a strike strike. What's it called? Price slices. Price slices.
Oh, the price slices, right?
But look at that. Just kind of look at the numbers, see what happens as the stock is moving up and down. Simulate the stock moving up and down, and look at what happens to your P&L, and ask yourself why. Why is this happening? Yep. All your answers are there. All your answers are there. Get a calculator like the one from what's that other site? OIC, right?
OIC, Options Industry Council. Yeah,
Options Industry Council. Start playing around with it. Practice. It's not rocket science. It's not particularly hard.
It's not.
It's not a fire hose worth of information. I know it feels like that, and it kind of seems like that, but it's really not. It's really not. Once you get started, the relationships just absolutely totally make sense.
But if you do this one time, do it one time in the morning, one time in the evening, sleep on it, get up, do it again in the morning. And after 30 days, you'll look at this and go, why was this so hard? How did I even ask that question? Painfully obvious. You'll go, you know what? Now I've become a better options trader, because you'll start to see relationships that you've never seen before. And this entire game is about pricing relationships. So we hope that helps. A little bit of an add-on from last week. And we thank you for being here. Again, we hope you picked up some good stuff. Stu, thanks for being here. And we'll see you next Thursday, 4 p.m. Eastern, for our next Coaches Corner. One quick final note. Bill, you said just now, this whole thing is about pricing relationships. So let me just take a couple of seconds here and say, well, okay, let's look at a call at $5. Well, what does that mean? I have no idea if that's high or low or good or bad or indifferent or what does that mean? Could be this strike, that strike, this expiration, that expiration. It means nothing. It means absolutely nothing. But relative to something else, it can mean everything. Is it cheap? Is it expensive? Relative to that, we use a metric called implied volatility to help us measure that price. But in the end, it's really about the relative relationship to the stock, to the stock price, to the time, to another option on the board, to another few options on the board. When we put them together, like this is three different strikes. There could be 4 different strikes. There's all kinds of different strategies. But at the end of the day, an option does what an option does, and you can predict what that option will do when you give yourself the what if scenarios. What if the stock goes here in a week? What if it goes here today? What if it goes here in 6 months? Right? Just plug it into this model, assume a certain implied volatility, interest rate, and bang, you have your answer. And now the answers of what will happen. Now the question of what will happen is answered. Yep. It's answered. It's right there. It's right there in front of you. You just have to practice it so you can get an idea of what this particular strategy will look like in the future, down the road. Absolutely. On an assumption of time and stock price and implied volatility. Yep. Spoken from somebody who's got nearly 30 years of experience as a floor trader and market maker. So if it's important to him, it should be important to you. All right. So always remember that. Don't let this stuff overwhelm you. Just work with it. So I hope that helps. We'll see you next week. And thanks for being here. Thanks again, Stu. We'll see everybody next Thursday. All right.